European Central Bank has raised its key interest rate for the first time in 11 years.
Later this week, the European Central Bank plans to increase benchmark interest rates by 25 basis points. Could the bank take the markets by surprise with a larger hike? As the tension builds, so do predictions of its consequences. Make sure to stay tuned until the very end to find out more. Hey guys, welcome back to another amazing video. Today in this video, we'll be discussing why the ECB has hiked interest rates and what it means for the market. But before we head to our topic, make sure to subscribe to our channel Economy Expert for more such economy content. In an effort to control the Eurozone's out-of-control inflation, the European Central Bank raised interest rates on Thursday for the first time in 11 years. The 19 countries that use the euro as their common currency are represented by the ECB, which shocked the markets by raising its benchmark rate by 50 basis points and lowering its deposit rate to zero. Traders were anticipating a smaller increase of 25 basis points. In a statement released on Thursday, the ECB stated that the Governing Council concluded that it is appropriate to take a bigger initial step on its policy rates normalization path than announced at its last meeting. Since 2014, the Frankfurt, Germany-based institution has maintained rates in negative territory at historic lows in order to address the coronavirus pandemic and the region's sovereign debt crisis. On hearing about the more aggressive rate hike, the euro increased to a session high and was trading at $1.0257. The 10-year Italian bond rate also increased in response to the announcement, extending gains made earlier on Thursday in response to Mario Draghi's resignation as Prime Minister. The ECB's decision to raise rates by 50 basis points and to soften its forward guidance demonstrates its beliefs that the window for further rate increases is rapidly narrowing. This change in interest rates, according to the ECB, will promote the return of inflation to the Governing Council's medium-term aim by bolstering the anchoring of inflation expectations and by guaranteeing that demand circumstances adjust to deliver its inflation target in the medium term. The target inflation rate set by the central bank is 2%. As consumer prices continue to rise, the ECB has previously said that it will raise the rates in July and September. However, it was not obvious whether it would go so far as to reduce rates to zero. Currently, the bank's deposit rate is 0%. Its main refinancing operations is at a 0.5% rate and its marginal loan facility rate is 0.75%. Following the announcement of the decision, ECB President Christine Lagarde explained the rationale behind the greater increase, stating that inflation remains unacceptably high and is projected to remain well above our objective for some time. The most recent figures show a slowing in growth, casting doubt on the trajectory of the economy until 2022 and beyond. The ECB is not strengthening its policy in the face of good economic growth, according to Seema Shah, chief strategist at Principal Global Investors, and definitely not accompanied by joyful smiles, she added in an email. There is no other developed market central bank in a worse situation than the ECB, she said. The ECB is hiking into a substantially slowing economy, facing a severe stagflationary, when inflation is too high and the growth is too low, shock that is quite beyond its influence, while also facing an Italian political crisis that presents a difficult sovereign risk dilemma. The bank has raised interest rates for the first time since 2011 and did so with a vengeance, according to Carsten Brzezinski, global head of macro at ING Germany. The ECB's decision to raise interest rates by 50 basis points while easing its forward guidance demonstrates its belief that the window for further rate increase is rapidly narrowing. Inflation in June reached a record high of 8.6% according to the first reading. However, given this forecast for a recession later this year, several investors are dubious about the ECB's measures. In June, the ECB predicted an annual inflation of 6.8% and 2023 inflation of 3.5%. The central bank anticipates 2.1% GDP growth this year and next. In the future, one of the main questions is whether Russia will fully stop supplying natural gas to Europe. As the EU imposes severe sanctions on Russia for its unprovoked attack in Ukraine, Moscow has been convicted of weaponizing fossil fuels. Since June, natural gas shipments have decreased by nearly 60%, although supplies through the crucial Nord Stream 1 pipeline resumed on Thursday after maintenance, albeit at a reduced capacity. Although this isn't the EU's base case scenario at the moment, Paolo Gentiloni, the EU's Commissioner for the Economy, has stated that a complete stoppage in supply from Moscow might cause the Eurozone to enter a recession this year because of how dependent Europe is on Russian hydrocarbons. According to Lagarde, a protracted conflict in Ukraine remains a source of major downside risk to development, notably if energy supplies from Russia were to be blocked to the point that it forced rationing for businesses and people. The EU's executive body, the European Commission, recommended on Wednesday that EU countries reduce their gas use by at least 15% until March in order to better manage the winter's reduced Russian supply. Investors were closely monitoring the specifics of the ECB's new anti-fragmentation tool on Thursday, which is intended to support countries like Italy that have significant debt loads and high borrowing costs. This new tool is known as TPI by the central bank, Transmission Protection Instrument. According to the statement, it can be used to combat unwarranted, chaotic market dynamics that represent a substantial threat to the transmission of monetary policy across the euro area. The ECB continued, the size of TPI purchases depends on the seriousness of the risks facing policy transmission. Details revealed later on Thursday indicated that the technique may be applied in cases where countries face rising borrowing rates that are thought to be unrelated to their own faults. Their adherence to sound and sustainable fiscal and macroeconomic policies was the main condition. This assumes special significance in the context of Italian politics, where it is now anticipated that early elections will be held in the fall as a result of Prime Minister Mario Draghi's resignation on Thursday. To make use of the new tool, a credible administration that adheres to the goals set by the European Commission will be essential. The ECB added that its purchases would concentrate on assets from the public sector with remaining maturities of between 1 and 10 years. If appropriate, purchases of securities from the private sector could be taken into account. Purchases would end either upon a lasting improvement in transmission or based on a judgment that persisting tensions are caused by national fundamentals, the statement reads. Additionally, after statistics revealed the US economy contracted for a second consecutive quarter, fueling worries a recession may spread to Europe, traders rushed to reduce bets on the European Central Bank's tightening policy and bonds rose. At least since the middle of June, money markets have been pricing less than 100 basis points of increases by December in accordance with swaps connected to ECB meeting dates. After regulators abruptly raised the interest rates last week, tightening by roughly 140 basis points, a period of negative interest rates came to an end. The Italian bonds, which are among the most vulnerable to the possibility of reduced rates, drove a rise throughout the area. The country's 5-year yield fell by 20 basis points to 2.41%. Additionally, German 2-year yields fell to their lowest level since mid-May. As a result of Russia's decision to reduce gas exports to Europe, the area is currently dealing with record inflation and exorbitant energy expenses. The ECB's ability to raise rates aggressively has been severely limited as a result, with traders already speculating that its first round of rate hikes in a decade may come to a stop this year. According to Mikhail Olaj-Miloj, senior analyst at Danske Bank AS, markets have traded on hostile central banks in the first quarter of this year because of strong inflation. But the onset of a recession and central bank reversals are probably the next big issues. According to Antoine Beauvais, rates strategist at ING, I honestly think not many people expected that ECB would increase quite as much as it was valued 6 weeks ago, but everyone was terrified of fading the move as it was governed by the US market. ECB observers are also keeping an eye out for hints regarding a new weapon in the bank's tool set for monetary policy, the so-called anti-fragmentation program, in light of Italy's high public debt and poor growth. This aims to reduce the difference in borrowing costs between the strongest and weakest nations in the Eurozone. And that's all for today. Thanks for watching. Let us know your thoughts in the comment section. And if you enjoyed it, please like, share and subscribe to our channel Economy Expert for more such amazing content. See you in the next video.